Clint, here we are on Thanksgiving Day, 28th of November. It's been an interesting month. On the face of it, quite a quiet month really for big news flow, but underneath the surface a lot going on. Would you like to give us a brief overview?
Yes, a lot going on, but the news continues to be dominated by the Fed in the US and the whole tapering discussion. So there were a few other interesting things, but without question the market is being dominated by that as the big event, and we've been saying that for a few months. I think we're going to continue to say it for the next few months. And intriguingly, the month started with some very good numbers coming out of the US. Everybody's focus is on the payrolls, job creation every month, because the Fed has indicated that that's a statistic they're watching very carefully. And as we know, the tapering decision is data dependent. What happens is the numbers come in at over 200,000 jobs created in October. That was a very good number, way above expectations. So immediately the tapering decision came back into focus, and people said, well, maybe they are going to taper after all in December, and it's not going to be deferred until next year. So the month started off on actually, interestingly, a positive note for the economy. Job creation is good. It shows the economy is doing quite well. But it means that the tapering decision will come sooner rather than later. So what happens? Interest rates on bonds go up. It was a relatively poor month for bonds, and it created problems in those markets, asset classes, sectors which have become most sort of liquidity dependent: gold, emerging market equities, emerging market debt. So there was quite a contrast in the month, and some really interesting things around that Fed decision.
If we stick with the Fed then, Janet Yellen is the other sort of big news story with relation to the Fed.
Yes, well, as I said, the month started with positive payrolls. We also had a very positive GDP number, 2.8% growth in Q3, quite a bit above expectations, although some of that was due to inventory accumulation, so perhaps not quite as strong as it would initially seem. But nevertheless, data coming out of the US was good. Then we had Janet Yellen, her nomination hearing in front of the Senate. And she was viewed to be dovish, but the market was concerned, is she going to remain dovish when she becomes chairperson of the Fed next year? In the event, she made some really very dovish statements along the lines of saying that the economy was performing far below potential, inflation was not an issue, unemployment was still far too high, and she referred to the fact that there's no firm decision on the timing of tapering, and she's trying to distance any tapering decision quite clearly from any decision on a rise in interest rates. So that was perceived to be a very dovish statement, so it helped to calm the market's nerves a little bit, and again the question then came back, well, maybe they're not going to taper in December. So it's all about the short-term timing of the tapering decision. Of course they are going to taper at some stage in the next few months, but we'll come back to that. But overall, what we saw in the month was a bit of seesawing on this whole timing of the tapering decision, but it again illustrates just how important that is to markets. The thing the Fed is also trying to do now is to make it very clear that when they start the tapering, that's reducing asset purchases every month, which are running at $85 billion a month, remember, that does not mean they're going to tighten interest rates. And they're now talking about, behind the scenes, actually lowering the unemployment threshold. Currently they've set that at 6.5%, lowering that before they'll even consider an interest rate rise. And there's talk around of lowering it to 6%, possibly even 5.5%. So they're trying to sort of make it very clear to the markets that yes, they're going to taper at some stage in the next few months. They're going to cut back on asset purchases, but they're not going to change interest rates for a very long time to come.
So mixed news flow from the largest central bank in the world ultimately over the period.
Yep.
Had the markets chasing its tail a little bit.
Yep.
Largely a subdued period in November?
Yes, it was a subdued period. Broadly speaking, the fixed income markets did not do very well. Government bonds saw typically rises of about 20 basis points in interest rates, so the government bond index across the world was down about 1%. Treasuries saw yields backing up to close to 2.8%, having been about 2.6 at the beginning of the month. That fear of tapering coming back, but there were more significant moves in, as I mentioned earlier, the liquidity-hungry markets. So emerging market equities came under some pressure again. That had a bit of a bounce back in the previous couple of months. We saw emerging market equities across the world down by about 2.5% to 3%. Some markets, particularly in Asia, coming under quite a lot of pressure. And Indonesia has become the focus of investors' attention in Asia. It was down about 10% in the month in dollar terms. India was down, Thailand down quite a lot. So you could see signs of real nervousness appearing there again. Emerging market debt was down a couple of percent in the month. Gold fell about 6% in the month. Gold, a classic sort of liquidity-dependent market, and getting back towards the lows that it reached when it sort of first went into this bear market dive earlier this year, getting back towards $1,200 an ounce.
Moving elsewhere in the world then, an ECB rate cut, was that a surprise?
It was a bit of a surprise to markets. We had alluded to it in our last month's discussion when we said that the ECB was considering a rate cut at some stage in the next few months. What happened was that some inflation numbers came out. They were actually surprisingly weak inflation numbers. The Eurozone inflation has fallen now to the lowest level for quite some years at 0.7%. Some countries are in outright deflation, and that's mostly peripheral Europe where they're suffering these big austerity cuts. But the ECB is clearly worried behind the scenes about deflation, and I think that's a theme that's going to run for a little bit. You know, inflation so far is the dog that hasn't barked, and inflation is actually not the issue today. It's more deflation. So yeah, the ECB cut rates from 0.5 to 0.25%, and they're beginning to talk behind the scenes about unconventional monetary policy, full-scale quantitative easing, which they have not yet done to date. All their monetary policy actions have been sterilised so far, but that could well be the next move of the ECB. They cannot afford for the Eurozone to go into a deflationary spiral. They're looking at what happened to Japan, the lost decade that we all talk about in Japan, and Japan is struggling now to overcome that, although with a little bit more success. But yeah, Europe is battling with that deflationary sort of concern. Having said that, the markets in Europe have done well this year. They've been relatively sort of cheaply valued, so they've held up pretty well against this sort of background. And the damaging markets this month was more in emerging markets rather than the developed markets, which outperformed by quite a bit.
If we move from deflation to still pretty decent growth, China's third plenum, a pro-growth event, really?
Yes. Difficult to say whether it was a sort of pro-growth event, but most, and it's always difficult reading the tea leaves out of these big sessions of the Communist Party in China. But this, remember, was a sort of policy-setting agenda for the next roughly 10 years, following the election of the new leadership a year ago. And most commentators have seen the reforms that have been announced as the most profound for at least a decade. They're talking about liberalising financial markets, money markets, the banking system, state-owned enterprises, headline-catching things like relaxing the sort of the one-child family policy, because we know there's a demographic bombshell actually in China coming around. So some significant things that they've announced, and the market saw those as positive. So we had a big month in Chinese markets, up between 5 and 7%, depending on which of the various markets you look at. Still a poor performer, incidentally, China this year and over several years. But of course the key now is implementation of these reforms. Yes, it was very positive sounding stuff, and the new leadership has recognised there's got to be significant change in China, restructuring of the economy, which we've talked about. These reforms will go a long way towards achieving that if they implement them effectively and efficiently. That's the big if.
Moving slightly more west again, Iran's nuclear program seems to have some sort of positive result for the Western market.
Well, we've been concerned, sort of geopolitics has been an issue, and the Middle East is the focal point for that, and we've been concerned that whilst the sort of Syria has been catching the headlines for a couple of years, that behind the scenes Iran is arguably a bigger threat. Again, new leadership in Iran, sort of rapprochement with the US, first contact between the US president and the Iranian leadership for about 30 odd years since the revolution. And finally, we seem to have something of a breakthrough here where Iran has agreed to curb its nuclear ambitions in return for a relaxation of sanctions. It's a short-term deal, but there's every expectation that in about 12 months' time that will be embedded into a longer-term one. Clearly positive news, and good news arguably for the oil price, because at the moment the sanctions on Iran are causing Iranian oil production to be close to 2 million barrels a day below what it could be. The oil price fell quite sharply on the news, but we're not going to see an immediate flow of Iranian oil back into the market. It's going to trickle in So the oil price has actually edged back up a little bit. It hasn't really changed very much over the month. Overall, I would say this is a positive development, and I think it will have a negative pressure on the oil price, which is good news for markets because it's effectively a tax cut to the consumer. So, yeah, I'd say medium term, this is a significant positive development.
Looking forward then, clearly it's a world dominated by central banks, loose policy. How are valuations looking today?
Well, I think the problem in markets is that they have become liquidity dependent. We've seen that particularly in emerging markets, precious metals, and we do know we're going to get tapering around the corner. We could argue about whether it's going to happen in December, March, whatever. I tend to think it's more likely to happen only when Yellen has been implemented as the new chairperson of the Fed, and it's going to come probably March. I think they'll be fairly slow in implementing it, but nevertheless it will come. And that's going to be something of a challenge for markets. We also have budget negotiations to come again in January in the US, and markets are up a long way. I'm not talking here the emerging markets because they're down over the last 12 months or so. Developed markets are up a long way, and valuations have become, I wouldn't say excessive, but they're clearly not as attractive as they were 18 months ago. So there's now something of a danger that upsets on the macro data, or a bigger tapering decision than the market is currently thinking, problems with the fiscal negotiations in the US, those sorts of risks could now have a bigger negative impact on markets because valuations have got to sort of relatively high levels. And remember, the S&P 500 yet again at an all-time high. So the PE not stretched, but quite a bit higher than it was 18 months ago because the markets had such a big move. So I think a little note of caution over the next couple of months or so as we get through this tapering decision, as we get through potentially some difficult calls in the US on the fiscal negotiations through January and early February. Deflation issue in Europe is a worry, and I think that's going to continue to be a feature next year. So a little bit of note of caution. We're certainly not chasing markets at these levels, and we want to be ready with a little bit of cash in reserve under these circumstances for when markets have something of a dip, which is, I think, quite possible over the next couple of months.
Excellent. Thanks, Glenn.